Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths inside financial reports, and today we are diving deep into Extra Space Storage's latest report, which shows some interesting shifts in their world of storage units. Prepare for a financial deep dive that will make you rethink your closet organization. If you love getting the real story behind big companies, make sure you are subscribed. And hey, we are building a fantastic community over on Discord, linked right below this video, so do join us there for more discussions. Alright, let's start by looking at the big picture of what Extra Space Storage Incorporated is up to. This is their quarterly report giving us a snapshot of how they are doing between July and September 2025. When we look at their balance sheet, which is like a financial photo of their assets and what they owe, we see their total assets reaching a huge $29.2 billion. That is a lot of storage space. On the other side, their total liabilities, meaning what they owe to others, are about $14.7 billion. This means they own more than they owe, which is generally a good sign. But we'll dig deeper into that debt later. Now, let's talk about how much money they are actually making and spending. For the 3 months ending the 30th of September 2025, their total revenues were $858.5 million, up from $824.8 million last year. That is a pretty good jump in sales. Their property rental revenue alone went up by about 3.5%. Showing that more people are renting storage units or paying a bit more for them. But of course, it costs money to run all those storage units. For the same 3-month period, their total expenses were $474.2 million. So after paying for everything, they brought in $174 million in net income for just those 3 months. That is a solid profit. Looking at the longer 9-month period of 2025, their revenues hit over $2.5 billion and their net income was a massive $721.7 million. This shows a consistent upward trend in their earnings, which is definitely something to watch. Here is something important. They show a significant loss related to selling off some of their properties. For the 3 months ending the 30th of September 2025, this loss was $105.1 million. This sounds bad, but it is often a strategic move to sell underperforming or less important properties to make way for better investments. For the 9-month period, this loss was $70.2 million. They also mentioned they had 29 stores classified as held for sale at the end of September 2025. This strategy of selling off assets is common in real estate, aiming to streamline their portfolio and focus on the most profitable areas. Now, let's talk about debt. Their interest expense for the 3 months was about $149.7 million, and for the 9 months it was $438.2 million. This is a big number, and it is going up. For the 9-month period, their total face value of debt was over $13 billion. That is a lot of money they owe. The good news is that most of their debt, about 83.8%, is at fixed interest rates, meaning they are somewhat protected if interest rates go up. However, the total debt has increased, which we will keep an eye on. When we look at funds from operations, or FFO, which is a key metric for real estate companies, Extra Space reported $445.1 million for the 3 months ending the 30th of September 2025. For the 9-month period, it was a whopping $1.3 billion. FFO is important because it gives a better picture of the cash flow generated by their actual real estate operations, by adding back depreciation and accounting for property sales. This FFO number is strong and consistent with their overall profit growth. Let's zoom into their existing or samey stores. For these stores that have been around and stabilized, their rental revenue was essentially flat, at $674 million for the 3 months. This might sound like no growth, but in the real estate world, flat revenue on mature properties can actually be a sign of stability, especially when compared to operating expenses. Their same-store operating expenses did go up by about 5.8% for the quarter. This is mostly due to increases in payroll, marketing, and property taxes costs that tend to rise with inflation and business activity. Even with rising expenses, their same-store net operating income, or NOI, saw a slight decrease of 2.5%. This is where you see the pressure of rising costs on their core, established properties. It means their older, stable stores are not generating as much profit as they used to in percentage terms before accounting for all the overhead. However, the overall picture for their entire portfolio, considering all their properties, the NOI is still very healthy. They're bringing in a lot of money from rent. This report also highlights a significant increase in their cash flows from operating activities, reaching $1.48 billion for the 9-month period. This increased operational cash flow is a positive sign for their financial health. However, their investing activities, which involve buying and developing properties, show a large outflow of $697.7 million. This means they are actively investing in growth, which is generally good, but it also means less cash is immediately available. On the financing side, they used $811.8 million. This is largely due to repaying debt, which is like paying off loans. They also raised a lot of money through issuing bonds, about $1.65 billion, which can be used for further investments or to pay down other debts. Now, let's touch on market risk. The company is exposed to interest rate changes. They mentioned that if interest rates went up by 1%, their interest expenses could jump by about $21.4 million annually. This highlights the importance of their fixed rate debt strategy as it helps cushion them against unpredictable rate hikes. When we look at the risks, they mention things like changes in the overall economy, competition, and even cyber attacks. A key risk they highlight is their dependence on technology. In today's world where everything is connected, a cyber attack could seriously disrupt their operations. They also point out the risk of not being able to close on pending acquisitions, which means their growth plans could be halted. It is important to remember that this report contains forward-looking statements. These are essentially educated guesses about the future based on current information. They are not guarantees, and many things can happen to change these predictions. They wisely put a warning about this right up front, reminding investors that actual results could be very different. So, what is my take on Extra Space Storage Inc? Based on this report, their revenue and net income are growing, which is always a positive sign in business. They are actively investing in new properties, which suggests they are confident about future growth. The FFO figures are strong, showing good cash generation from their core operations. However, the rising interest expenses and the significant amount of debt they carry are areas to watch closely. While most of their debt is fixed rate, any further increase in debt levels could become a burden. The strategic sales of properties, while often a good move, do show up as losses in the short term. Overall, Extra Space Storage appears to be a well-managed company with a solid strategy, but like any business in a competitive and dynamic market, they face risks. Their resilience in managing rising expenses and a steady growth in their vast portfolio are their main strengths. That is our deep dive into Extra Space Storage's latest financial report. What do you think about their strategy of selling some properties while buying others? Let me know your thoughts in the comments below, and if you found this breakdown helpful. Make sure to give this video a thumbs up and subscribe for more corporate decoding. Don't forget to join our Discord community for more in-depth financial discussions. Thanks for watching, and we'll see you in the next video.